All right, let me take it across to our guests joining us on the programming, Sharmila Vellon of Asianomics Groups, as well as Peter Cardillo joining us today on the show. Appreciate you both taking your time out and speaking with us. Sharmila, let me first begin by asking you, the markets, of course, have given the thumbs up. We were expecting that there's going to be at least some form of an indication coming in from the US Fed, and there you go, Jerome Powell saying that we will see tapering by the end of the year, even as they will be keeping a very close watch on the incoming data, possibly an indication that they will be looking at the September data in terms of how the employment scenario is is really looking like. Your first thoughts on the speech that we just heard?
Hi, Ruchi. Thank you very much. I thought the Governor Powell was kind of quite dovish. It's clear that they want to start tapering, but they're very much in the mode of watching data, which is understandable. There is a lack of clarity in that we don't know the outcome of the Delta variant. What we do know is that new cases are picking up very, very rapidly, running at about 170,000 per day, up from about 13,000 in July. And then also you got the ending of the federal employment support benefits in September. So, the message was very much, would like to taper, hoping to taper start tapering by the end of the year, but, there's a lot of moving pieces in between. I think the one thing that he was very clear was that interest rates aren't rising anytime soon. And also he seemed to be quite sanguine about longer term inflation.
Absolutely. Let me also take it across to Peter Cardillo as well. Peter, how are you looking at the commentary coming in from the US Federal Reserve Chair? He did talk about how the incoming data is going to be very important, even as the Fed is going to keep a very close watch on if the inflation pressures become more broad-based and whether we do see any kind of uptick in wages as well. How are you looking at those factors playing vis-a-vis, of course, the concerns emanating from the Delta variant as well?
Exactly. Basically, Fed Powell stuck to his script. The only key here is, and the change is, that we finally know that tapering is about to happen in the fourth quarter. And that's key. And actually, that's very positive for the markets. He spent a lot of time talking about inflation. He spent time talking about the coronavirus as being the risk factor. He spent time on the job markets, that there is still work to be done. So basically, I think he gets an A+ for today's commentary because he's calmed the markets. And he's also saying, even though he continues to say that inflation is transitory, he does put a question mark to that, meaning that the Fed is probably more concerned about inflation that they are really expressing. But the key is that he's ready to deal with it and that the economy no longer needs crutches. It's strong enough to stand on its 2 feet.
Sharmila, if I can take that question with you. The observation coming in from Peter is that the Fed seems more concerned about inflation than what they're reflecting and showing at the moment. Would you agree with that argument?
I think I'm going to have to disagree with Peter on this one. I think the Fed is very much saying that the recent spike in inflation that we're seeing is transitory. Powell was at pains to say that there's nothing that is suggesting that the disinflationary trends that we saw pre-COVID won't reassert themselves, or that trend has been reversed. And again, he was very kind of spent a lot of time, as Peter said, talking about household expectations, and that household expectations have moved up. But that's the short-term expectation. The longer-term expectations haven't moved up. And I think, the Fed is pretty sanguine, and wrongly so, because there's a lot of liquidity in the system. You look at the Fed's balance sheet since pre-COVID, it's increased by 98%. They've purchased assets to the tune of $4 trillion US. You look at household demand deposits, they're sitting at close to 3.7 trillion. This is all money which is in the system. And if you believe that inflation is everywhere and always a monetary phenomenon, there is no shortage of liquidity. So my view would be that, yes, a lot of the recent spike we're seeing is transitory simply because supply is catching up with demand. And the numbers will start coming off. We're even beginning to see that, as Governor Powell said, in the durable goods space. But inflation post-COVID is going to be higher than pre-COVID.
Right. In fact, Jeff Tennis also joining us on the phone line. Jeff, just be on the line with us. Let me take another question with Peter. He's also with us. Peter, given the fact that a lot of emphasis was given on the labor market prospects as well. The U.S. Federal Reserve Chair did say that the prospects, of course, have brightened. We're seeing better hiring, but they will be looking at the jobs data going forward in the month of September very, very closely. How are you looking at, how we're seeing the job market really recovering in light of the concerns of the Delta variant emanating?
Yes. I think we'll see an acceleration of non-farms payrolls increasing rather rapidly, but that's probably not going to come until October. And I say that because in September the supplements come to an end, and that means a lot of the low-paying serving jobs will be full because people will go back to work. Right now, they're making more money staying at home as opposed to going to work. So that all is going to come to an end by September. And that's why I say we'll see an acceleration of jobs growth begin to kick off in October. But I want to make one thing very clear. Yes, as your previous guest stated, that there are inflationary aspects that are temporary. I do agree with that. But the key that's missing here is not so much the bottlenecks, but wages. And wages are going to go through the roof as the economy opens up 100%. Of course, if the coronavirus is persistent, then that will prove me wrong. But I believe that the coronavirus is not going to, will not mean further lockdown.
Right.
And that means that the economy will continue to reopen.
Let me take it across to Jeff as well. Jeff, thank you very much for joining in. Just yesterday, I remember when you were on the show with me, we were talking about how you were also expecting the U.S. Federal Reserve Chair to indicate a possible taper by the end of the year. So, would you say that this is on expected lines?
Oh, absolutely. I think it's fantastic news what you've had today from Chairman Powell. He's basically doing what he should be doing, which is signaling a start of this tapering process. It's got to happen soon because inflation's too high, the economy's doing well. And I think the way he's phrased it is exactly what I thought would happen. I said this yesterday, that they're going to be very, very cautious about suggesting when interest rates may rise, and I think that's way down the road. But he's telling us that tapering is going to begin before the end of the year, and I think that's absolutely the right thing to do. I think the markets are reacting very well to it. I've argued for a long time that once effectively the tapering announcement occurs, although it's not happened yet, of course, formally, but once we know they're about to taper, the market would actually rally because we knew it was coming. Let's get it out of the way. This is completely different from the taper tantrum of 2013. So I think it's good news, and I think how the economy plays out with the Delta variant, as the previous speaker said, and how inflation plays out over the long term will determine when interest rates are going to rise for the first time. But for now, this is great news because the tapering's got to happen. It's not necessary to have this amount of QE right now, and I think that the market should greet this as a pretty good policy initiative and one they should be happy about.
Absolutely a sigh of relief. But, Sharmila, if we can draw comparisons to what happened back in 2013 vis-a-vis what we're seeing now, do you believe now the markets, of course, have a lot more certainty, especially after the U.S. Federal Reserve Chair has said that they will be looking at incoming data. They're watching out for what kind of shape the recovery will take. They want to fully support the economy as well as give the markets some sort of an indication as to what the timeline may look like as well.
Ruchi, I agree with what Jeff said that tapering is going to happen, right? It's already pretty much discounted in the market, and so it's not coming as a surprise, and it's being been signaled all along, and so therefore it's hard to see a taper tantrum. It's very different to the last time round, right? So it's been fully signaled. It's mostly discounted by the market, and again, it's going to be gradual. And the main point that Powell is making is that it's an appropriate time to taper, but it is not an appropriate time to start raising interest rates. And he was very at pains to separate out the two. That tapering does not mean interest rates. The conditions that are leading to the decision to taper are not the conditions that are underpinning the decision to raise interest rates quickly, right? And that the whole maximum employment criteria is still to be met, and interest rates rises are further down the line. And I think the market is relieved by that.
Right. Absolutely. In fact, Jeff, if I can take another question with you, and that, of course, is the commentary that's come in on inflation. While Jerome Powell has said that he will be looking to, make sure that inflation is anchored at the 2% level, the commentary coming in from Peter is that perhaps the Fed is much more concerned about inflation, as they would like people to believe. Would you agree with that hypothesis? Would you agree with that argument?
Absolutely. I think I've said for a long time, several months, that I think the burden of proof on those who think it's going to be transitory is where the need to demonstrate that result is coming from, because inflation is running at over 5%. I completely agree, I think, with Peter, that, wage inflation is running hot. It's going to continue to run hot. The shortages of labor, apparently in various parts of the economy. And so I think what the Fed is doing here, they're saying, look, monetary policy at the level it's been, $120 billion of QE every month at zero rates, is less and less appropriate. We're going to start to reduce that accommodation. But obviously the ability to adjust interest rates down the road or to accelerate the pace of tapering will get driven very much by inflation. And I'm afraid to say, I see there being a quite significantly more serious inflation problem on a 6 to 12 month view than the Fed is currently assuming. And that probably means ultimately the rate hikes may get brought forward. And we haven't even discussed this massive amount of fiscal stimulus, which is going to come through as well. So my view is inflation may be transitory, but I'm not convinced that's the case. I think it's a much, much more risky problem than the Fed is assuming.
Okay. Okay, all right. On that note, Jeff, Sharmila, as well as Peter, appreciate you all taking your time out and helping us make sense of the key commentary coming in from the U.S. Federal Reserve. In fact, as we